Hello, everybody, and welcome back to another video. I'm Gav Blacksburg, aka Wolf Financial.
Let's hear some deep dive analysis from our lead analyst's logical thesis.
Hey everyone, today we're going to discuss how and why the Fed funds rate impacts Bitcoin prices. The Federal Reserve's federal funds rate, or the Fed fund rate, is a key interest rate in the US economy, representing the rate at which banks lend to each other overnight. Changes in this rate can have a significant impact on financial markets, including the price of Bitcoin. Here's how and why the Fed fund rate can influence Bitcoin prices. First, interest rates and traditional markets. The Federal Reserve uses interest rates to control inflation and influence economic growth. When the Fed raises rates, borrowing costs increase for consumers and businesses. This often leads to a slowdown in spending and investing in traditional financial markets, causing stock prices to fall. Conversely, when the Fed lowers rates, borrowing becomes cheaper, which typically boosts investments and economic activity. Bitcoin, while not a traditional asset like stocks or bonds, still reacts to these macroeconomic conditions. As a decentralized digital asset, Bitcoin is viewed by many as an alternative store of value and investment. When traditional markets face downward pressure due to higher rates, investors may turn to Bitcoin as a hedge or a speculative asset. Second, risk appetite and inflation expectations. When the Fed raises interest rates, it signals an effort to combat inflation, which can dampen risk appetite across markets. As investors shift towards safer, higher yielding assets like bonds, Bitcoin may lose some of its short term appeal. Conversely, when the Fed lowers rates, it often signals economic uncertainty or efforts to stimulate growth. During such periods, investors may seek alternative assets like Bitcoin to preserve value, particularly if they anticipate rising inflation. In a low interest rate environment, Bitcoin's appeal as a hedge against inflation grows. Investors may turn to Bitcoin when they fear traditional currencies, such as the US dollar, will lose value due to prolonged low rates and inflationary pressures. Third, liquidity and market sentiment. Changes in the Fed fund rate can also impact the liquidity available in financial markets. A lower interest rate typically leads to an increase in liquidity as banks have more capital to lend and investors are encouraged to borrow. This extra liquidity can flow into speculative assets like Bitcoin, driving up its price. In contrast, when interest rates rise, liquidity tends to tighten up, and investors may be more cautious, which could suppress demand for Bitcoin. Moreover, Bitcoin's price is heavily influenced by market sentiment, and changes in the Fed's policies can shift investor outlook. A rate hike often signals the Fed's concern about inflation, which may reduce enthusiasm for riskier assets like Bitcoin. However, when the Fed cuts rates to stimulate the economy, optimism may grow, helping to fit Bitcoin's price as investors look for returns outside traditional assets. In conclusion, the Fed fund rate plays a crucial role in shaping the economic landscape and influencing investor behavior. As a result, changes in the rate can significantly impact Bitcoin prices. When the Fed raises rates, traditional assets may become more attractive, reducing demand for Bitcoin. Conversely, when the Fed cuts rates or signals inflationary pressures, Bitcoin often benefits as investors seek alternative stores of value. Bitcoin's reaction to interest rates reflect its complex relationship with traditional markets, economic conditions, and investor sentiment.
Thanks, everybody, for tuning in. Make sure that you subscribe to the channel that you're watching this on. If you want more great ideas and education around finance, go ahead and hit the subscribe and like buttons.